Hey, hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to get you folks what you need to know before you roll, and that's going to be talking about economic data, how that impacts the overall markets with just a little market analysis, maybe sprinkle in a little geopolitical fodder to round that all off, and then talk about some strategies we could implement into a portfolio based on these assumptions we come up with in the market analysis. All right, so without further ado, let's get on with the economic data across the pond. Not really a whole lot to talk about here. The real thing I want to talk about is the housing numbers we've been getting here in the United States. So we've been getting some interest rate moves, right? So I'm going to actually try and pull up my, there we go. Let's pull up go ahead and get into the markets here. So we've got the bonds here right now. So something to talk about what we've been seeing going on recently. The numbers we got out most recently is the housing data. Remember, we saw some building permits coming out, things like that yesterday. We saw the NAHB, National Association of Home Builders Index. That number came in quite terrible, to be quite honest, came in at 55, expected to be 66. Housing starts came in at 274,000, expected to be 285. These are yesterday's numbers. They also revised last month's number down by about 500 or about 5,000, I should say, on that number. So all those numbers getting lowered, not really super surprising. Keep in mind that the numbers we just got were from June. So a little bit of a lagger there. Something else to note here going forward, when we saw these numbers come out, oh, I don't want that. Sorry, I'm trying to find my pen for you folks. So when we saw this number come out, if we look back to June here, June we saw was the rising interest rates. So this is kind of what we were seeing, these interest rates start to rise, because when we're talking interest rates versus the price here in the bonds, when the price is going down, the interest rates are going up. They're inversely correlated, folks. Okay, so we got price going down here, and interest rates are moving higher. Then now we're starting to see this rebound, but this is after this economic data points that we started coming out. So they were seeing rising interest rates. They were seeing a slowdown in the housing market. As a matter of fact, we're already starting to see some of these housing markets peak a little bit. Now we're still seeing gains for the most part, but we aren't seeing these multiples like we saw before, 10% increases in housing. So the higher interest rates have seemed to slow down at least the housing market. We saw today building permits coming in a little bit higher than expected. But remember, when we're talking about building permits, they can pull as many permits as they want. It really comes down to whether or not they start building on those. So housing starts came in a little bit lower than expected at 1.56 million, or 1,560,000, expected to be 1,570,000. So slightly lower than expected there on the starts. But the real key here is the home builders are seeing the retailer like you and I come in and not look at the houses that were as big as they used to be. Now they know that we all have this budget, so they're also very hyper focused on this pricing around this. One of the things with this building permits, albeit it did come out better than expected, one of the areas we look at is the single family home, multifamily homes, single family home permits started coming off quite dramatically. I mean, we've already heard from Pulte and some of these major Lennar, major home builders. Those folks are really saying, hey, this is becoming a problem for them, that folks aren't really coming out looking for to buy a house. Now, the rental side of the coin is doing very well. So rentals are still holding their price gains there, at least right now. So with the bonds moving back higher, that means we've got bonds moving higher. So we've got price moving higher. It's the same teeter-totter, and that means interest rates are moving down. So you can always look at it that way. Markets moving higher, price moving higher. It is a teeter-totter effect. Okay, so easy to follow there with something like that. Now, moving on to crude oil futures, yesterday, big rally. That's going to be kind of suspect going forward. We're already seeing the lack of demand there. But again, we talked about, you can do the supply and demand curve here, and it's pretty simple. Right now, supply is flatlined. Demand is likely increasing. So what happens? That means that price has got to adjust for that. All right. So anytime you have a slack in demand or slack in supply, increasing demand, that means that when we're talking with price has got to move higher there. And that's what we're seeing here in crude oil. And it's a future, folks. So a lot of folks out there are clamoring at the fact that, yes, we are producing probably the second most we have in history. We've ramped up from the shutdown from COVID. We're producing again. Now, that's all well and good. But again, we are stuck on the same supply as we were before, and there is increasing demand. We've seen some demand still out of the manufacturing sector. So there is demand out there for crude oil with the same supply. That's why we've seen these prices incrementally move higher, despite the fact that we're producing the same amount of oils before. The expectation that future supply is going to come on the market is not there. So that means the price is moving higher. All we have to do is say, hey, folks, we're going to open up these oil fields. We're going to start releasing permits, just say we're releasing permits, and that will cause this price to really come off because the expectation of more supply coming onto the market is good. Now, we already saw Biden go to the Middle East to try and get these folks to lower prices. Well, they're not going to. They're not going to limit get these prices to come off at all now that the fracking is out of the picture. If you also remember back when we were producing before, it was the fracking operations. Saudi Arabia knew we had as much oil as them. Yeah, it was a little bit more difficult for us to get it out because they're taking oil out of sand, and we have to take the sand out of the oil. So that's we have to take the oil out of the sand here because we have to squish it out. Over there, they just have to filter out the sand. So it's a much easier process. Sorry if that confused anybody the way I said it the first time. So when we had the fracking going on, they pushed these prices lower to try and get our fracking operations to a price point where they weren't making money, and that's right around $50 a barrel. So without that fear, these folks aren't going to do anything. They love higher prices. They would love to see $200 a barrel oil. All right, we're the only ones that can stop that from happening, to be quite honest, especially right now with what's going on in the Ukraine. So this is the major driver of inflation, folks. There's no way around it. It is what's driving prices higher. Government intervention, trying to tell folks what they have to do with sustainability and other things is really, anytime the government forces us into a corner, it causes prices to move higher. All right. If they try and limit prices, well, hey, then nobody's going to produce it because the prices are too low if they artificially suppress those prices. Okay. It's not a free market and folks aren't going to be playing that game. All right. So yesterday, NASDAQ was toying with this 50-day simple moving average. And as a matter of fact, we were above that when we talked yesterday. Some weakness off of those housing numbers, pretty dismal, causing the markets to really sell off to their lows. It makes it look like it's more of an indecision day, to be quite honest, here in the NASDAQ, and a retracement or a settlement above that would just be a continuation pattern with that market setup there. Again, yesterday, crude oil we talked about, like to see that market come off a little bit. Again, this did settle closer towards the bottom here. Settlement right around here at around 31,200 would have been something that made this chart look like more of a continuation. A little bit messy here, though. We did test the 50-day simple moving average again and failed here, though, in the Dow Jones Industrial Average. But again, market feels pretty strong today, despite these weak numbers that we've been seeing. We can see Bitcoin was making a bit of a move, causing NVIDIA to follow that tail lead. So anytime you're talking about trading Bitcoin, another trade is in NVIDIA that you could be playing around with. We've got XRT here. The reason why I was looking at this is we're getting a lot of patterns that set up like this, where it looked like a bit of a topping yesterday or the previous day, and then another doji counter opposing that one. That's usually set up for a continuation pattern. So a lot of markets, while we are getting these tops or a little bit of a gap pop up here and a doji, those could be considered continuation patterns because they're within the previous move. So when we're talking about this previous move, this little gap up kind of happened within there. So it's not something super strong that we would see, as we would see as if that doji popped down here and was kind of dangling all by itself. That would look like a much stronger bottom there with these markets there. And then we can go on to gold futures, which just are dismal to say the least, especially with this high inflation that we've been seeing. I'm just extremely surprised that we're seeing that kind of downward momentum with gold, and we have inflation where it's at. It just is really bizarre. Now, getting over to the E-mini S&Ps, yesterday on the data point, we can see that this happened right on the release of the NAHB right there at 10 o'clock. The market just free fell, almost no relenting until the end, which was only, folks, short covering. This was intraday short covering that caused this little bit of a blip to the upside. We could see even overnight inventory probably covering some of that. So while we've gotten a bit of a bounce at this point, it's really up in the air. To me, risk is to the downside because the economic data points are not coming out any better than expected. Unemployment's not doing well. We're seeing inflation on that, as a matter of fact, with the wage inflation still not getting the folks off the porch and out into the workforce. I don't know what it's going to take to get that to happen, but folks just aren't willing to come out and work for the wages that they were making or what they considered themselves worth. To be quite honest, they may have even been making less before and think that their value is more now because of inflation. A lot of folks have been hearing that you got to make about $5,000 more this year than you did last year due to that inflation. So those are levers and pulleys in the markets that are going to be weighing on this. So I would say risk is to the downside. If you haven't covered those calls from the last sell-off there, where we were talking about selling some puts and some names we like, we've gotten a recovery here. This is the location where we start looking to cover those calls, get out of them. We're not looking for taking 100% of max profit on these trades. We're looking to try and get out about 75% of max profit, which, you know, in the last couple of weeks, putting those on with this little bit of a rally, that should clearly be an easy choice to make on covering those, because now it would be on another sell-off looking to reallocate some of those short put strategies. Okay, so that's what I'm looking at today. We're looking to cover some of those short puts and reallocate. If you haven't done it yet, bonds might not be a bad place to start selling some covered calls, lower overall cover, lower cost basis on those bonds. I showed you how to do it. I know you don't have munis in your portfolio. I know you don't have revenue bonds in your portfolio, but we have instruments that we use to lower overall cost basis on that portfolio. Part of the portfolio we can't necessarily touch. All right, that's the bond portfolio. And again, your bond portfolio is reflective of price. So as that price goes down, so does your portfolio value. All right. And I show you how to counteract some of that like trading options. All right. So that's all I got for you folks. I hope you have a great day. And if you can't take that, take it easy.